In this video, we're going to talk about depreciation. We're going to see what is it, how do we calculate it, and how do we put it on the table we need to build. So the first thing is, what is it? Well, depreciation represents assets loss of value. Assets are things that the company have. They have a building, they have a car, they have a truck, they have a machine, okay? And those things are going to lose value. Why do things lose value? Well, there are three different reasons for that. The first one is because of use. When you use things, they lose value. And the best example is a car. The more kilometers you use it, the more value it loses. So that's the way of representing how the car is being used and how the car is losing value, okay, through depreciation. The second thing is just as time goes by. So you can have a car and it's parked in your parking lot or wherever. You're not using it at all, but after 20 years, the car is going to be old. It has lost value, even if you have not used it one single time, okay? Just because time goes by, time passes. And the third main reason is because there are new technological advances. So your machine, your car, or whatever you have will become old because there are new things that incorporate new technology, okay? So your thing is losing value. In all these cases, the company is going to need money to buy a new one, okay? So whenever we talk about an asset, we refer to things that are going to stay in the company for a long time. We're talking about machines, we're talking about buildings, okay? And in our case, we're always going to use the first depreciation I explained, which means is the depreciation because we're using that thing. We're using the machine, we're using the building, and we're using it to produce. The more we use it, the more it loses the value, okay? There's just one exception for this. Lands. Lands do not lose value, okay? And whenever the company is using those things, the company already knows that at some point they will need to buy a new one, okay? So what does the company do in order to get ready to have the money to buy that new thing that it's going to need in, let's say, 5 years or 10 years or whenever? Well, the company takes part of the profits into a savings account, okay? And this savings account is what in accountants we're going to call depreciation, okay? So this is how the company is preparing to buy the new thing in the future. They have a profit, they take part of the profit, they put it in the saving account, and this saving account is what we call depreciation account. Okay? So if you want to master depreciation, you need to know, first thing, there are several depreciations. We're going to see them in a moment, okay? There are several interpretations of the depreciation, and we're going to learn how to calculate all them. Second thing, lands, they never depreciate. Third thing, what is the residual value? I will explain you, okay? We need to explain what exactly is the depreciation base and what are the formulas you need in order to calculate all these depreciations, okay? As I said before, lands do not lose value. This is the only asset in the company that it's going to increase value with time. What happens if we're talking about agriculture? Well, this is a very specific thing, okay? And in this case, we should speak about lands completely differently. But we're not going to work with agricultural companies. We're going to work with other kind of companies. So for you, absolutely in all cases, lands do not lose value. What is exactly the residual value? Well, the residual value does not depreciate neither, okay? Because it's money that the company gets at the end of the time when they sell something as a scrap or they sell it to another company or anything like that, So maybe you're wondering why a company will buy something that it's a scrap for another company. Why will they pay for that? Well, in the case of a scrap, it's quite clear. It's a completely different business. You know, there are these places where you can take a very old car and they sell it by parts, okay? But maybe in other cases, you don't see so properly why is this happening or how this could happen. I'm going to explain it with an example. I think the best one is a mobile phone. Probably you have already noticed there's a big difference between the kind of use you make of the mobile phone and the use your parents or maybe your grandparents make of it. This implies that for you, the mobile phone has a very short useful life. Maybe every 2 to 3 years you want to change it because you want a new one with a better technology, with better applications, and with better hardware and software and everything, okay? But your parents, your grandparents, they don't need to change the mobile phone so often because they are not interested in using so many apps and they are not making so much use of it. This means that you're thinking about changing your mobile phone and it's working, it's still working, but it does not give you everything you want because you want to use different apps or you want to do something that your mobile phone does not allow you to do. This means also that you could get some money for your new phone if you reach an agreement with your parents, your grandparents, and they pay something for your old phone. For them, it's a good treat. They get a better phone and they don't pay a lot for it. You will help them to use it, you will set it up for them, so it's a very good deal for them. But it's also a good deal for you. You're going to get some money, and with that mobile phone you don't want anymore, and you will use that money to pay your new phone. That money is the residual value. Knowing all this, you can calculate depreciation base and take notes of this formula because you're going to need it absolutely in all the exercises. What is depreciation base? Depreciation base is the part of the asset that depreciates. So we have the whole asset, the asset value, and we have to remove land because they do not depreciate, and we have to remove the residual value because it does not depreciate neither. So depreciation base is asset value minus land minus residual value. And this is the first thing you always have to do related to depreciation. First thing you do this, and then you proceed to calculate different depreciations and whatever you need, okay? But first thing is calculating depreciation base. So it's already time to talk about the formulas. We're going to use just one method. It's the straight line method, and we're going to see two versions of it. One is the percentage. So we're going to multiply the depreciation base by a percentage, and you will have your depreciation calculated. The second way is the useful life. So we will divide the depreciation base by the number of years of useful life that that asset has. We're going to see now the different depreciation types. So the first one we're going to talk about is legal depreciation. Legal depreciation is what happens according to the profit and loss account. This is the depreciation that the tax office of the country allows. Every year, the tax office publishes a chart in which they say which asset is going to last how many years or is going to depreciate according to this percentage. And those are the number of years or the percentages that legally you can place in your accounts. In the very old times, this did not exist, and any company was doing whatever they wanted. But after some time, the tax office decided they needed to make it a little bit more homogeneous for all the companies. So they decided they were going to set a maximum amount of years and a maximum percentage to depreciate the assets. And in your chart, you're going to place this as an expense and a cost. Then we have total depreciation. Total depreciation is what really happens in the company. It really reflects the depreciation, the loss of value that that asset is having in the company because of the way they are using it. Okay? And this depreciation does not appear in your chart. Do not put it on the table. What you're going to do with this one is that you're going to calculate over the law depreciation. Okay? Over the law depreciation is total depreciation minus legal depreciation. And this is an opportunity cost, which means it's just a cost, nothing else. And this reflects the part of the depreciation that the company cannot place in the official accounting. Okay? It's very important to calculate this depreciation because you cannot put it in the legal account. Okay? This depreciation exists and the company has to take it into account because they have these special savings, okay, to replace the asset. So they need to take it, this over the law depreciation, and consider it in order to do bigger savings, okay? They usually place it in the internal account of the company. And for our chart, it's going to be a cost, an opportunity cost. Whenever you think this is illegal, you're completely wrong. This is not illegal. It just means it's over the law, and it just means that legally you cannot put it in the profit and loss account. That's why companies have a second account in which they place real things that happen in the company. Okay? Why is this like that? Because you have to think that depreciation is an expense. The bigger the expense, the smaller the profit. The smaller the profit, the less taxes you pay. So tax office is not very happy when you have a lot of expenses, okay? So again, this does not go against the law. It's completely legal, but you cannot put it in the profit and loss account. That's why we call it over the law depreciations, okay? It just belongs to a different way of counting things in the company. So this is how it goes in your table, okay? You have the legal depreciation. It's a cost because this happens when you're producing, and it's an expense because this belongs to the production department. Over the law depreciation is just a cost because it's an opportunity cost, and total depreciation is nothing. We don't put it on the table. Last thing, super important thing you need to know about depreciation. It's never a payment, okay? Think again about the car. Every time you use the car, so it depreciates, you go back to the shop and you give more money to the shop because you're using the car? No, you don't. That's why depreciation, it's never a payment. And this is one of the biggest mistakes you can do in the exam in this course, okay? And if you do it, you will have to repeat the exam because the exercise will be completely invalid, okay? So please pay attention and do not make this mistake.